Alright, let's get rolling. Let's start this space. Let's kick it off. That was a song called Hello, Good Morning. And I'm going to say that John requested it. They're like a radio show host on board. Great to have everyone here. If it is your first time here, tap the react button on the bottom right of your screen and hit a clapping emoji. If it's your first time in a LinkedIn audio space. Look at that. Some new faces, new names. Good to see. Oh, wow. That's a lot. A lot of people's first time. A lot of people on the panel's first time listening. So this is a two-channel communication. We're going to host this space and moderate it in the best way possible that I know how. And that is through engaging with the audience. So we will direct the conversation. And it could go either two ways. So maybe you want to talk about the structure about DAOs. We're going to hit a love heart. If we're going to talk about more tokenomics, we can hit a clapping. The whole idea of these LinkedIn, I don't want to call them spaces, but these LinkedIn audio is to provide a different perspective to the LinkedIn community. Obviously, we have the Twitter communities that exist. This is a little bit more on the formal side. However, they can still be fun, even when we're talking about tokenomics. In saying that, Ivan is the host, co-hosting from Pixel Boss. I'm at the Pixel Boss Club right now. And today's conversation is on tokenomics. So as an icebreaker, I'm going to do a 30-second answer from everybody. It is, and I'm going to start off with Harly, Sand, and then Daniel. The question is, first, what do you do in 30 seconds? And what is your biggest ick when it comes to tokenomics? And ick is something that grinds your gears. I'll start off with Harley. I'll start off with myself. Let's jump in. Daniel, NFT Melb, NFT APAC. We run a bunch of fun events in Web3, as well as leading up Pixel Boss with Ivan, a Pixel Boss Club, agency and platform that is being built. And my biggest ick when it comes to tokenomics, tokens, is shit names. Start off with Harley, jump in.
Hey, Harly Zappino, partner at Neolegal, law firm specializing in crypto blockchain, partner at Blockchain Australia, tech and consultancy firm, and then I have a family office as well. Biggest ick with tokenomics, pump and dumps. Yeah, that's me.
We'll go to Stan and then Daniel. Thanks, Harley.
Hello, everyone. My name is Sander. I'm the CEO of Beast and Hive. We are based out of Switzerland, and we aim to democratize the financial market by tokenizing private equity investments. And I think the biggest ick, I think, for me is the same as Harley, the pump and dump. We need to get rid of that.
Hey guys, my name is Daniel, DAOmaster Dan. I'm the founder of DAOmaster Labs, and at DAOmaster Labs, it's our job to help founders launch their projects with mastery into the Web3 space, and we specialize in DAO dissemination, tokenomics, and gamification of complex systems. My biggest egg with tokenomics is poorly designed tokenomics that sort of result in a broken ecosystem, token dumping, unregulated bullshit pretty much in the space that everyone's probably very familiar with.
We're going to move to Ralph, John, and then Viroshan. Let's go, Ralph.
Hi, guys. My name is Ralph. Like Harley, I'm a partner at Neolegal and Blockchain Australia, same legal and tech firm specializing in tokenomics, business modeling, and incubation. Look, my biggest ick is tokenomics that are missing actual business models. Nothing has changed in this world. We still have all traditional business, so tokens are just fueling the economy. So that's what's my biggest ick.
Hey guys, my name's John. I'm the founder of NFT Sydney and a DGen. My biggest ick when it comes to tokenomics are tokens which call themselves DAO when they're not decentralized, they're not autonomous, and they're not organizations. So just really bad naming and, tricking a lot of people into thinking their vote matters. When it's only a handful of people who control everything behind the scenes and call the shots. So that's my biggest ick.
So my name's Viroshan. My background is in maths. I'm a mathematician. I started working on agent-based models and consulting, thinking that was tokenomics, and solving difficult problems. I would say my biggest ick is that people think tokenomics is a spreadsheet when actually your tokenomics is your business model plus your incentive design. And I'm currently building a super interesting tokenomics model for a blockchain insurance startup. Okay, cool.
Thank you. Thanks, everyone. Let's get into it. And as we do, because this is Web3 nature and everyone that is listening, if you have any questions for myself, Ivan, for any of the speakers, if you want us to touch on any topics over the next 52 minutes, hit the top 3 button. See those 3 dots in the top right? Press event details, and then you can comment on this event. So you can ask any questions. I'll be moderating it, so I'll keep an eye out if you have any questions, and then we'll leave the last 10 minutes. Anyone can raise their hand, come up on stage, comment, add a statement, ask a question. Let's do it. Kick this off with you. Let's start, my friend.
Awesome. Thanks for this together, Daniel and Ivan. Really awesome space. I guess I just wanted to kind of start off, for those who don't know what tokenomics are, obviously it's an extension of the word token and economics for anyone that can put 2 words together. But I did just want to dive into some of the principles of tokenomics for those who aren't familiar. So I guess the principles of tokenomics and what you're looking to maximize is your utility, your value capture, and your tokenomic security. So we'll just briefly detail through all of those. And obviously, tokenomics is not an easy subject. It's something that's still being defined. It's something that didn't really exist until we saw kind of the initial kind of DeFi summer. I think that's when tokenomics really kind of emerged as a term which everyone kind of paid attention to. And that was around August 2020. So it's been just 2 years since I really started to see that phrase pop up. Obviously, in the ICO, or the initial coin offering mania, we did see some pretty poorly designed tokenomic structures as projects were going live on Ethereum, which were heavily skewed towards the team, basically making a lot of money at the expense of most retail token purchases. But back to those 3: utility, value capture, and tokenomic security. So utility, I like to consider, is the usefulness of a particular token, and by extension, its protocol. So probably the best example that I can think of, and the largest token of its category, is Uniswap. We can also talk about USDT, but I think Uniswap is a better example. So the Uniswap token actually has a built-in fee switch, which can potentially accrue revenue from fees from the Uniswap protocol. So what's really interesting to see is if that fee switch is switched on, that suddenly brings revenue into the actual token itself. Or maybe if you stake the token, there might be certain requirements like KYC. Regardless, I think that's a really interesting model, and that could be an example of utility. We've got value capture. So that would be the amount of value a token accrues from its use in protocol. So some tokens are more valuable within certain kind of DeFi ecosystems than others. And then also tokenomic security. So it's how the incentives align within a particular protocol. And I think this one is really slept on, because what can potentially happen is you can have a really sturdy protocol, but it's still highly centralized. And a few actors, whether it's the team, whether it's a few whales, end up calling all the shots, and there really isn't that same security. So if you can rig votes, if you can rig elections, and we'll hopefully cover that as well, how secure is your project? Why is there even the point of using a token if you can just have a few actors basically manipulate everything on-chain? So the good thing about blockchain is it is transparent. You can usually see who the token holders are, who has the voting power. But those are kind of the 3 core tenets, and I invite everyone in the room just to expand on what they think of these 3 core principles, and if there's anything they'd like to add or adjust. So for everyone in the room again, utility, value capture, and tokenomic security. I'd like to open it up and see if anyone has any talking points on those 3.
From the panel, feel free to jump in. Otherwise, I can add it and throw it to Daniel for a question. Jumping in. Daniel, when you're looking at these 3, utility, value capture, tokenomic security, what are you particularly focusing on particularly coming from the DAO side, and then working with brands like Pummel, which is like a move to earn. I know you were quite keen helping Pummel launch. What went wrong, and I'd love to hear what went right as well.
Those are all pretty equally as valuable as the other. Stools sort of don't exist without three legs. So I think utility, value capture, and security are sort of your minimum requirements for building out some sort of tokenomic model. And then beyond that, it's what else am I introducing into the ecosystem, or why am I sort of addressing and building out this model? Because like some of the panelists have already attested to, it's like there needs to be a legitimate reason as to why you're building out the token. There needs to be a reason why the framework exists. And from that reason, you can then build out potentially a unique framework that exists for that project. So when I was building out Pummel's tokenomic model, we sort of wanted to figure out a way to build out how do we educate Web2 users, and how do we bring them onto the Web3 space. And Pummel already had a pretty well-established app that allowed users to earn in-app tokens only. And so it sort of made sense to build out a model that allowed for tokens to flow easily from a Web2 ecosystem into the Web3 space. Thus, as users jump into the Web2 familiar app and start to earn what feels like a familiar currency, over time they may help to build up their knowledge and education skills around getting into the Web3 space. And so that's been working pretty well so far, which is really, really good to see. And then eventually what will happen too is Pummel will introduce a burn function into the Web2 app, where you can burn your in-app only tokens at a standard value exchange for an actual Web3 tradable asset. And then that then allows those users to enter into the Web3 ecosystem. So it's sort of like, it's a dual token model, but it's dual token in the sense that it's an infinite supply, in-game only, valueless, non-tradable token, paired with a finite supply, valuable, tradable token. And sort of getting those tokenomic elements can be quite, getting them right can be tedious at best, but we managed to figure it out, which was good. Stuff that went wrong.
Dan, just a quick integration here. Yeah. Anyone in the audience, put a clapping emoji if you know what a dual token is, and a thumbs up if you don't. So if you do know what a dual token is, clapping emoji, and if you don't, a thumbs up. Let's go. Let's see. Let's have a look. Thumbs up. All right. I see a lot of thumbs.
We've got a few thumbs up.
People don't know what dual tokens are. Let's jump into that. Touch on that.
Yeah, sure. So the best way to understand what a dual token is, a dual token sort of exists to be honest, rather than trying to explain it in depth, let's sort of look at an example. So Steppen is an example of a dual token where they have GST and GMT, where it's sort of one side may act as inflationary and one side may act as deflationary. And sort of what Steppen were trying to do is achieve some sort of consistent growth over time. Obviously, that didn't work to their favor because instead of that happening, their token price was absolutely pumped and then eventually dumped. So when you're thinking dual token models, you could think of Steppen as pretty much the highlight of both the move to earn space and the dual token model. There was also, I think Axie Infinity may have played around with it potentially when they were doing the play to earn. I could be wrong. But yeah, if you're thinking dual token, think Steppen. Really what dual token models tries to do is it tries to bake in both inflationary and deflationary elements of the ecosystem. If it's double deflationary, then you're probably burning too many tokens. If it's double inflationary, there's probably too much supply. So one side will act as some sort of inflationary token and one side will sort of act as a deflationary token. And to sort of break that down, inflationary tokens are tokens that are added to like the circulating supply over time. Deflationary tokens are tokens that are burned or taken out of the supply over time. So probably the most famous inflationary token in the world is Bitcoin. And even though obviously it's slowly being added to the supply over time, it's still being added, so therefore it's inflationary. And then the most famous deflationary token, and something that John's actually highlighted over the past few months, is Ethereum. Ethereum has actually gone deflationary as a result of converting over to POS. So probably like really, really complex shit, but yeah, that's sort of like a high level perspective on what a dual token model is and then what it means to be inflationary and deflationary.
Thanks for the supply and demand technicalities. I'm learning a lot here as well. I want to jump into absolutely everyone on stage, and I want to do the best I can. From a mathematics standpoint, I want to touch to Viroshan, what do you think most people are getting wrong in this space from a mathematics standpoint? And let's ensure that we simplify these answers and then take it high level as well.
Yeah.
That way we ensure that the audience understands it, but more so that Daniel understands it. Because, I love when you guys get technical, but simplifying it is going to make all our worlds easier. So the question was, what do you think a majority of tokenomics brands or companies are getting wrong?
So I think you have to, the most interesting tokenomics is done by a team called Block.Science. So they do a lot of research into tokenomics fundamentals, and the fundamental model in inverted commas is that you have to stop thinking about like scalars. So tokenomics is not described by single numbers like inflation, and you really have to think in terms of vectors. So every wallet is a position, and every position.
You want to touch on what a vector is, everybody?
Yeah, well, that's what a vector is. So a vector is a collection of numbers, and each number has kind of a pigeonhole. So when we think about like token ecosystems, we've got to think about you have 100 users, and each of them has an address, and the evolution of the system will be on the basis of like how those 100 users behave at any given step in time. So like when you think about tokenomics, you should think about dynamics and think about like how the users are stratified and how they're likely to behave. So like when we design, we have like some users that are very like long-term invested, and so the velocity of their tokens, so how quickly their tokens change, is going to be lower than somebody who's just looking for quick flips. And you can really see this in a nice way with NFTs, because NFTs are kind of a small like subset microcosm of market behavior that then filters into tokens. So I really think like you have to focus on trying to translate like micro behavior into macro behavior, and I think the other blind spot is that everybody, like, tokenomics has evolved from the ICO phase, where the main focus was on pumping value and trying to build a raise, so kind of fundraising and crowdfunding. But it's moved away to building really interesting business models, and this is where I think the future of crypto is, because you can build interesting business models that are like a combination of public and private partnerships. So kind of like a football team is a partnership between the club owners and the fans. So or even a YouTube channel is a partnership between the YouTuber and the fans. And somehow there's value in monetizing that partnership. And so in crypto, what we're saying is like, there's this public-facing area where people hold tokens, and that's kind of the token commons. And there's a small group of people who design the initial parameters of this particular space. So where tokenomics can improve like greatly is to understand the parameters and make them fit the problem, rather than just being focused on raisins. And I think that's the big change. And then from a more technical standpoint, you need some skills that are taught in I think first year algebra at university. So it's like called linear algebra. And once you've got linear algebra, you can do quite a lot. And they're good tools. So people like the Token Engineering Commons and the CAD community have built like very good education programs to teach people how to use quite sophisticated tools for modeling token behavior over time, rather than just having a static picture of this is my token distribution table and this is what I'm going to do with it. I mean,
I definitely know who to go to for any linear algebra, because I'm not going
linear algebra. Yeah, I spent too much time studying.
So you're extremely technical, very, very clearly. I'd love to throw this to the panel.
Yeah.
or even Harley, because you deal with so many large business models. How do you simplify tokenomics into the implementation of these business models?
For me anyway, when we consult clients, basically what we like to do is keep it nice and simplified for the client themselves. So what I'm going to go through is a very simplified version for everyone to understand nice and clearly. So generally, when you see a project, right, you see tokenomics, and what you see are numbers. But in reality, those numbers are not actually the token economics. Basically, that is only an issuance chart. And it generally doesn't give you the whole of the issuance chart. So let's take that preconception out of the picture that tokenomics is simply the numbers that are issued or released from a project. What you need to take into consideration when you're looking into token economics is basically, like a lot of the panelists have already said, is the business model. So the business model of the project itself. And the business model of the project itself should create a sustainable ecosystem for the project. So think of creating a model where a token will be used for a purpose. It's as simple as that. And basically that's what tokenomics should be built towards. Creating a token with a purpose that is sustainable for its purpose. So when we talk about sustainability, basically what we're hinting to is that ensuring that the price doesn't go too high, the price doesn't go too low. There is a use case for the token, so tokens can be used and go back to, let's say, the founding contract, but then can be issued again when it's required. So there's, think of it as though it's a circle, an ever-moving circle where tokens are going in, tokens are going out, being used and being redistributed. In some, or in most scenarios, obviously there's your exceptions. For example, your DAOs, where DAOs don't need to necessarily be used up, but they're used for a purpose of voting and whatnot, and they get more valuable upon the value of its use. So I would say maybe going back to the basics to keep it nice and simplified. Tokenomics, I guess, is not your issuance chart. And when we talk about your issuance chart, there's a lot of factors that you need to take into consideration. For example, if you don't have a use case for your project, then maybe you have longer vesting schedules until you do know you have a use case. So, for example, if your platform's not ready, you can go from there. So that is a very simplified version, and I think that's potentially where we should start with when we talk about token economics, and then maybe delve in a little bit deeper into the little bits and pieces. So if any of the panelists want to jump in and then move on to a more technical level, more than welcome.
I'll jump in now. If it's non-technical, that's when I can talk. G'day guys, Ivan here, founder of Pixelboss, and I'm a novice when it comes to tokenomics in terms of the technical back-end structure, but fundamentally my take on it all is that you've got a product that's being built on the blockchain and mostly, you know, obviously being crypto-related, but through my lens and what we're doing at Pixelboss, we want to use the technology to create community tokens that are actually paired back to a particular price depending on the client. So when they're on our platform, they can use those tokens to reward each other, to purchase things. And we want to keep it off exchanges so we can control the price, so we don't have pump and dumps. So a lot of the things that happen in blockchain when it comes to NFTs and crypto is you've got this, as we all know, that this bull market, this bear market, and it's subject to a lot of things, but fundamentally, we're looking at creating an ecosystem using tokenomics where we can reward community. And when I say we, our clients, because we've got major global brands that we're working with that are traditionally spending huge money on advertising, on digital, on above the line, on whether it be radio, TV, etc. They could barely track that, and we're taking a percentage of their sales and dedicating that to tokenomics, to community. And we know what it does when you work with people that you love. We know what it feels like when you feel respected and when you feel included. And that's fundamentally the thing for people that aren't Web3 native. That's the thing that's really sets Web3 apart from Web 2, is that it's the idea starts at the core and then it's built together. So if you're starting at the core of the community and you're rewarding them with tokens, and the ecosystem that we're developing for that is a percentage of revenue goes back into the DAO, therefore, and all that money goes back to community, and that's the ecosystem that we're developing. That's how we want to use tokenomics. Would love to hear some of the people on the panel that obviously know a lot more about this, if they've seen that play out and what their thoughts are on that.
So what I wanted the audience to think about tokenization and tokenomics in general is that it's a transparent tool where you can create value together without limiting people to participate. In a lot of the structures we have in today's society where you create value, you often see closed doors, and it's not transparent at all. With tokenomics, you can build the infrastructure for people to participate, be incentivized, and create value cross-border. I know a lot of people want to talk about the mathematics and everything, but at the end of the day, I believe tokenomics is the infrastructure for how we can globally work together with a clear structure and trust is in the code. That's at least how I look at it. And of course, that needs to be good and have high security. But at the end of the day, it's an incentivized model where people can work together. And you often call them DAOs or wherever. But at the end of the day, it's tokenomics.
I think you're completely right there, Sander. I think when it comes to tokenomics, I used to work in crypto VC, and I've seen a lot of these models which are really rigged towards your average retail user. So for those in the audience who aren't, who haven't been through this themselves, both in the ICO mania of 2018, where that's kind of the first foray when Ethereum tokens really popped off and people were interacting with smart contracts, depositing Ethereum and receiving these tokens. And these, a lot of these projects didn't really, plan for the market to react the way that it did. And obviously they collected large reserves of Ethereum, which then proceeded to drop 80% in price by the end of the year. So unfortunately they didn't really, account for that and budget that into their forecast. And unfortunately they weren't able to deliver on what they initially promised their holders. So amidst all the hype of the bull market, they raised a lot of money, which they ended up spending or wasting, and realistically that value wasn't really reflected on the token holders. What we've also seen in the DeFi space as well is we've seen a lot of DeFi protocols with massively inflationary, as we heard some people say before, to the point where, ultimately staking as a mechanism really only benefits the larger players in this space. So either the super early investors or the people who got in well before the protocol ran up in price, or also the whales. So the whales who are getting, ridiculously large returns on their staked assets, and are basically dumping them once again on retail users. So we've seen consistently smaller holders, maybe people with a few $100 or $3,000, investing in these protocols, losing out. And what I think is even more interesting is there's never been a worse time to hold your tokens on an exchange, because theoretically, if you stake a particular asset, and most ERC20 tokens at this point accrue some kind of staking, whether it's just the protocol dispersing more of their tokens to staking, or if you can actually earn a cut of the protocol fees, which is still quite early. I highly recommend everyone in the audience to check out a website called Token Terminal, and you can actually see which protocols are paying fees, what that fee revenue is over the course of 7 and 30 days. And effectively what we're seeing is we're seeing price to earnings models. We're seeing valuations starting to emerge for what makes a certain token valuable. Because if you're earning revenue from staking a certain asset, then that should somewhat influence in the same way, with stocks, you have cash flow, revenue, assets. We're going to see something very similar emerge in cryptocurrency in the next few years. So, I think it's definitely worth, studying on chain, seeing what the revenue, if there is any revenue, if staking, if it's just diluting. A lot of protocols, when you stake, effectively the new tokens that you're earning, and this is the case with PancakeSwap, if you stake the Cake token, the reward you get from the 40% APR or whatever it's at is actually new tokens being issued to your address. So theoretically, the more people stake, the more new tokens are being issued into the circulating supply. So it is a bit of a dilemma. It introduces some interesting challenges. But just back on Sanders' point, it is all about making sure that everyone gets treated to a certain degree fairly. If you're sacrificing, the tokens from your wallet, you should be, in my opinion, fairly compensated for the risk that you're taking. So did just want to add that point in there as well, about if you incentivize, if you take care of everyone from your whales and your large, institutional investors down to your ordinary retail holders, you build a very strong tokenomic kind of community, I guess.
Hey guys, I just want to jump in. We're kind of halfway mark now. Anyone that's new to the space, I encourage you to follow people in the room. The one thing I also want to say is there's never a dumb question, particularly if you're new at this. The best way to build is together. So please follow each other, ask questions. And again, we're being at the halfway mark. If you can be bothered, click on the 3 buttons, share the room. LinkedIn audio is fairly new. We've got, there's about 80 of us in here at the moment, which is fantastic. But the idea is to continue to sort of share this because it's a powerful way to communicate and build. So, well done to everyone that's come here today. And we've just had Matt join us. G'day, Matt.
How is it going, guys? Hope everyone is doing well.
Are you still in Dubai?
I just touched down back today in Melbourne. It's been already a busy day today as soon as I came on, but I just thought I'd join the conversation here and chime in a little bit on my experience with tokenomics and how we look at things. So I've been listening to the listeners so far, and obviously a lot of valid points. My perspective on tokenomics is this. Okay, so if you're a project founder, firstly, you could either be a project founder and invest into certain tokens or coins, but from a founder perspective, I guess the thing you got to really take into consideration is the type of economics. Let's call it economics, okay? Which is what you want to deploy in your project. And there's so many different types out there. We've seen, and some work, some don't work. Some work temporarily, some work long term. Ultimately, though, the key I think everyone should be considering is the functionality or the utility of that. It's a supply and demand matter. So, from a supply side, you can either be inflationary, deflationary, unlimited, etc. And from a demand side, it's what you're going to use it for. So, it could be, rewards, could be governance, could be, actually game utility or something like that. But I think there's everything to me anyway right now, as we know in this space, is not just speculative but experimental as well, to some sort of sense. Like, I think Satoshi, when he came up with his Bitcoin white paper and what he wanted to do, I don't think when he first started that he thought it would be what it would be today. Similarly with Ethereum, and their smart contracts addition to their method. But yeah, I think there's going to be more and more innovative methods coming out with tokenomics, how you can deploy them. Ultimately, you're going to need some really good mathematicians. Well, not necessarily mathematicians, but you're going to really need some good drive behind the project itself to understand what sort of value you can perceive out there. And I know a few mentioned about rewards tokens. And I think it's okay. Like, Ivan, I know you mentioned something about, you want to reward your holders with tokens. We got to always consider, yes, rewarding is easy enough. Like, we can use that for airdrops and transparency-wise, it's nice and simple to give it out to people. But will the users have some sort of use case for it later on? I think that's the biggest question we got to ask ourselves. And if we can answer that in a way that formulates the right strategy for the token, that'll be the best way to move forward. As far as, the people that you require or the planners require to get it done properly or to get it done strategically, this is where serious planning comes into consideration. And, we've done a lot of work with many projects to understand what their ultimate purpose is. A lot of the times, if they're just driving hype or they're driving some sort of market-making methods post the fact of launch. And I think someone else, was it Simon or someone else just now mentioned, someone else mentioned earlier on about, when your mainnet is not live or when your project is not live, actually using the tokens yet, then you're going to apply some vesting schedules and all of that. That's great. But it's always also good if you could, do that when your utility is ready. I think that's kind of key.
Jumping in here, Matt. In regards to jumping in here,
yes.
what do you? And I want to throw this to Ralph first, and I'd love for you to circle back on this. What do you think are the best examples of this sustainability and strategies on modeling?
Okay, so yeah, go on. Sorry.
Ralph,
you go.
And then Matt circle around.
So, look, my understanding is, I think if you guys go online, Forbes have recently, they posted online that 93% of the actual blockchain businesses with tokens have failed. Obviously, there are so many smart minds out there, then how come did they fail if they have actually applied all the mathematics or all the experience? Now, I guess what's happening, there is not enough data. If you go back to the traditional world, these people were very experienced. So traditional business had a benchmark to look at it, so they knew what models to create. And this space is so new, everyone is still trying to collect the data, and that's why data is so important. So this is why to create any tokenomics or sustainable model, first we have to go back to the beginning, how people used to build businesses. What were their products and business they're trying to set up? What are their services? What's their value proposition? What's the revenue model? Till we can't figure that out, that business model framework, we won't understand how the token going to work because we haven't worked out what's our revenue model going to be. Second thing, behavioral framework. We should never forget, I'm a gamer, Harley's gamer, we play games. People get excited when they get incentivized and they have to go on some sort of quest or some sort of competition where they get rewarded in the end. And gamers can wait for releasing of the games for 2 years, 3 years. And if you can't hook these people to hold on to these tokens and invest in this token because they don't see any growth or there's no behavioral nudges, they're not going to sustain. And when we get these two information sorted out, like a behavior side and business framework, from that data when we collect, we actually build the tokenomics with a proper supply, with proper incentive models, with proper gamification that, okay, if you are using this token and then we do an airdrop of this NFT, which allow you access to play different various games and you have to hold on this token because there's another future airdrop or other validation they're going to come in place, then people are excited. Till we don't sort this out, we don't have any data. We can talk about that, we can do this, we can do that. It is very, very difficult. And that's why I have always believed run a small proof of concept, MVP, figure this out, how you can generate the business through a normal revenue model. Then you should actually build the tokenomics so that you have enough data. And I'm pretty sure Viroshan will also agree to this.
I'll just jump in on there.
Yeah, that's in one.
That's great. Yeah. So from a Pixel perspective for our marketplace, we're first and foremost e-commerce. So our clients will dedicate a percentage of their revenue that will get converted into tokens and will only release tokens based on money in the bank, not on just pushing a couple of buttons and hoping they're a community token that people like, that they might get an airdrop on. Like it's literally going to be based on funding that is allocated through revenue or the client shifting money from marketing, advertising and sales into community tokens that are compared to whatever the split is in their regard. We're going to recommend dollar for dollar based on Australian dollar, but we'll have clients in the US, we'll have clients overseas, and there'll be certain brands that might want to go, you know what, we want to do a 10-to-1, whatever it may be, but it will always be based on money in the bank. So when it's distributed, it's not hot air. That's kind of our take on it, if that makes sense.
Cool. Can I also chime on something on a couple of years or real examples so people get some clarity on two parts to it. One is the onboarding and one is the holding examples. So just off the top of my head right now, we all know Telstra or Optus or any of the phone providers out there. Assume say Optus, normally the plan is $90 a month or $50 a month or whatever, right? They say, okay, listen, we're going to move to an Optus digital currency right now, cryptocurrency, and instead of $50, you're only going to be paying $25 right now. But you need to use this token or this coin, Optus coin. That's number one. So that's a good onboarding methodology because you're half pricing a customer's value proposition for what they got. That's number one. And number two, Optus might add on and say, hey, in order for you to retain this 50% discount throughout the whole way, you need to hold, X amount so that we can take it up from your account or prepay, kind of like a prepay kind of bank of your tokens, and therefore you can continue that 50% discount. So from an Optus, from a business perspective, number one is they will have clearly a really, really big onboarding mechanism for different users out there. That's number one. Number two, they'll have a holding mechanism as well, which will allow people to hold more, therefore lesser sell-off, and the supply will be lesser on the market if people want to invest in it and push forward towards that way. And from their point of view, they're going to be making good money because they themselves might hold tokens that are part of their vested interest to grow in value, so they will have that there. So I'm just saying this is just an example of, holding, onboarding that could work in the real world out there for particular value propositions. And I give you another example as well, just one other that was used. In fact, applied straight to my mom and my wife, who does not know anything about cryptocurrency. There's an app called Liven. They were using it. We obviously love our food, so we go out to restaurants all the time to buy stuff, pay big meals all the time, have a lot of family gatherings and all of that. So Liven has these offers on particular restaurants in Melbourne and Sydney and everywhere else where, you buy $500 worth of credit in that restaurant. They'll top it up with another $500. So in fact, you get $1,000 in credit. They obviously hold this in this app, and then my mom and dad, when we have my mom and my wife, when they have parties and all of that, we invite people in the restaurant and we use the Liven. Now, they did not know that was a cryptocurrency. After they told me, I went and did some research and I found that out. So I think, moving forward, there's going to be a lot of really cool functional use cases that us as consumers can benefit from, and also businesses can benefit from. So I think when we strike that equilibrium there, that's when we will have a really powerful source of transparency in the blockchain use case for these tokens, and that's where I'm particularly bullish on if more projects come out that way.
What are the best use cases that you've seen of integration? I want to throw this to Sander and Viroshan, being that you guys are tuning in from another time zone in Switzerland. I think it's 10 a.m. over there. So Sander and Viroshan, you guys are international, so I'd love to get your final thoughts before we wrap up the space. What are the best examples that you've seen for keeping a sustainable model within tokenomics? Sander, jump in.
I think, first of all, when you develop tokenomics, you need to explain clearly to the user what do they own. Like, when you're buying these tokens, what are you actually getting at the end of the day? I think that's where a lot of tokenomics projects fail, because most projects today, they print tokens to sell air. It's basically nothing other than funding for the project. I will say the best example we have is, of course, Ethereum. Ethereum has built this huge network where people can contribute and get rewarded, and their token itself also is used for payment and reward, and it actually holds value. So I think, first of all, we need to understand that tokenomics is economics on the blockchain, and it's much more transparent, but the users need to understand what they own, and if it's a reward of holding or staking or getting yield, you need to understand where the yields come from. If you don't know where the yields come from, you are the yield. I think that's where I want to end. That's it for me today.
Yeah, I think that's a super comment to make. Oh, sorry. Yes, so I think if you don't know where the yield's coming from, then you are the yield. But that's the same as like any big tech Web2 perspective. I think users don't need to know what's behind something. So I think the restaurant example is great. It's a blockchain, but you don't have to know what blockchain is to be able to use it and get a benefit. So those are good examples. And then on the more complex or technical side, I think we need incentives to solve problems that we can't do with general purpose money. So that's the only reason for creating a token, is because it has to be more effective than using dollars. And there are some examples where you can get that effectiveness. So if you think of industries where people hang on to private data, whereas if you would share that data and create some sort of data commons, the entire industry could get more efficient from people using tokens to buy the data, and then the participants who've shared their data could benefit from the value of the token going up as more people, as the demand for the data increases. So like one example of this, which I think has will have legs long into the future, is Ocean Protocol. I don't know if you've come across them, and they're building really interesting models where tokens are being used to access data resources. And then another area where tokens can be quite valuable in the data context is with IoT sensors, and where you're basically, everybody who has a sensor on their house can essentially become a data source, and they receive tokens for generating data. But you can have third parties who are, say, interested in the data outputs in aggregation, then reward whoever is participating in this economy. And those are problems that I don't think you can solve with regular fiat money, because the incentive has to come with the value that is being generated in the sense of the data point. So I've seen a lot of projects going this route. Helium's a good example. There are a lot of IoTex is another example of proof of data from devices. And as an end user, all you would do is install a device and then passively get income for whatever's being collected. And I think that's where Web3 has lots of power, and it's not just on the finance side.
I love that. And just echoing on from that, Sander, I think Ethereum having one of the best tokenomic models. Obviously, Ethereum is a cryptocurrency and a coin more so than a token itself. But what I've done is, if you click the three dots, if you're on mobile, if you click the three dots in the top right corner and go to view event details, I've actually shared a link, and I'll happily share more as well. So if anyone is interested, please reach out to me. We can keep the discussion going on the comments or the DMs if you'd like. But I've shared a website called Token Terminal, and that provides a dashboard so you can actually see, and I've got the example of Ethereum here, that Ethereum has collected $70 million of revenue in the past 30 days. And you can go through for specific DeFi protocols and chains and see how much value is being accrued on some of these chains, because some people say we're in a bear market. That's obviously price-wise that may be the case, but in terms of demand for Ethereum block space, that's still relatively high given the situation we found ourselves in. So there's definitely check out Token Terminal, and if you want a better breakdown of the Ethereum fundamentals as well, the site ultrasound.money will actually show you. Ethereum has gone back into, it was deflationary for the past few weeks, but it's actually creeped back up into inflationary territory. So as Dan mentioned before, based on the usage of Ethereum, Ethereum can be inflationary, deflationary, or actually hold its supply. So a lot of really, if you're a nerd, if you love data, if you love analytics, there's a lot of stats that you can really break down, and you can really forecast how some of these projects and coins and chains will evolve over the next few years. So wanted to throw that out there.
Thanks, John. You're a legend.
Can I ask questions to you guys about your thoughts on stake? Sure.
Yeah, go ahead. Before you ask that, I did promise that the last 10 minutes would be questions from the audience. So whilst everyone that wants to ask a question puts their hands up and requests to speak and ask a final question for the professional 8 people that you have on here, definitely not myself. I'm the 12-year-old in the corner trying to figure out how to play with the big boys on the playground. But for everyone else in the audience, please feel free to jump up, ask a question, statement. Matt, kick it off. What was your question?
Yeah, sure. I've got a kind of a question around staking. The methods used by a lot of projects in staking, right? And I come from the NFT space more so, but I've been understanding a lot about the tokenomics side on tokens and coins. With staking, I think there is a massive gap right now where people are not understanding, as in project founder side of stuff, what is the benefits of staking, or what is the basics of having a proper staking protocol. And I think, I know someone mentioned about passive matters with staking earlier on. I think it should also be problem solving, and either problem solving or algo solving in terms of what happens when they stake a particular coin or token. I'm in the gaming space, and I see a lot of these problems happening right now. NFT space as well, where people just say, "Yeah, stake your NFTs or stake your tokens, and you get rewarded X amount." I think that there is very complacent, and you can't really have any proper justification as to what the reason is for, other than just receive a reward. So I want to know from you guys, what do you guys think about that, and whether you've seen any other advancements out there.
So for me, when I draft up my token economic models for my clients, a lot of clients ask for staking, and I tell them that's absolutely bullshit. Staking is honestly, it's a trash mechanism. I know I'm being harsh, but you should never inflate your token supply passively. Everyone should be doing some form of work to earn tokens. Because basically when you issue tokens, what you're actually creating is a liability onto your company. Because at the end of the day, those tokens are free income, and people sell those. And that means that your company needs to market make. And when they market make, that costs you money. And if you want to maintain a certain price, it's going to cost you even more money. So for me, anyway, in most token economic models, if you stake, but if you implement staking, but you don't require those stakers to provide your company any form of value, then it is completely and utterly inefficient, in my opinion.
That's perfectly. I think can I add to that? Go ahead.
I would say that I 99% agree with Harley here, but another way of looking at staking is showing loyalty to the project, so you don't get a high sell pressure for the project, and then you can reward the user for being loyal in other things, for example, early access or other mechanism to incentivize. So I would say staking as a revenue or an additional income model is bullshit, but staking has a huge potential for proving loyalty to the project.
I think what the good example there would be Ethereum. And luckily they moved, or they did a really, really good move with the 2.0 merge on proof of stake rather than proof of work. Because I think that provides real value propositions to validators and the nodes of the whole chain itself. To go, hey, we're staking and we're actually earning something here, but it is about solving the actual, the main force of the chain, right? So yeah, go ahead.
The thing about Ethereum staking, though, the problem that it causes is it's created a monopoly within the market. The people with more Ethereum basically make more Ethereum. So,
isn't that the real world?
Hey guys, I'm going to cut you off.
Isn't that
Guys, I'm going to cut you off. We've had some other people come up, and we've got limited time. Love your guts, but Daniel, take over.
Just in order, of people that have come up, because I know there was some struggles to bring people up and down. Let's go some quick fires, and we may go 3 minutes over time. So I appreciate all the speakers that have come on board, and feel free to leave as soon as it hits 9. We'll start off with Boulevard, then Walt. If you have any short questions, any quick fire ones,
Thank you. My question is for Ali. Ali, you mentioned that the crypto company token creates a liability on the company. So what kind of company, what kind of liability is this that the crypto company token creates on the company after, they create the supply distribution interface?
Yep, so basically when you issue tokens, what a lot of people don't realize is that the companies are 99% of the time market making their own tokens. 1, to stabilize the price, or 2, to actually increase the price, 3, to show a sufficient amount of trading volume. Now, when you release more tokens into the market, people are generally, via a staking mechanism, people are generally going to sell those, unless there is some form of value for them to hold it. But in most scenarios, they will sell those to get their return on investment or whatnot. And that creates a selling pressure. So if you're a company that's willing to maintain the price, or if you're a company that's market making, your company is generally the one, in most scenarios, unless you're a super popular token, your company is the one actually buying those tokens back. So basically, it creates a liability on you when you create a higher selling pressure within your token.
So what about the token lockup period?
Yep, so token lockup periods are definitely a good tool to combat that, but that's only a temporary tool. So basically, you're putting a patch on the hole. You're not actually solving the problem. Those lockup periods those tokens will eventually get released, right? And that means there's just a much more significant selling pressure when they do release, as opposed to being released at the start. So it gives you a bit of lead time, but that's about it.
Thanks, Boulevard. Parvi, when I give you for the final question to wrap up the space, shoot away.
Awesome, thank you. Hopefully it's a short one. Thanks, Daniel. I just wanted to pick your brain, the guys that are on here. I know that we've seen tokenization being utilized across, gaming and sort of sporting industries. Are there any other ones that are sort of up and coming to watch out for, or, other industries where you've seen, this is the next big thing in tokens?
Using loyalty points. I think that could be a really interesting model, but I'll let, I think it was Sander, who unmuted his mic, I'll let him dig away, but loyalty points could be awesome.
I will say that access to the financial private market will be one of the major innovation we will see in the next couple of years.
It was a quick fire question, Pavi. Thank you very much for keeping it short, simple. Everyone, particularly the speakers, thank you very much for coming on. I do want to respect your time. These guys and Pavi as well is awesome on stage. Kings, queens, legends. Thank you very much. If you have any questions around more tokenomics, tokenomic structures, tokenomics, architecture, business model architecture. These, in my opinion, are the best people across the country to tune into and to ask. And they offer these as services as well. So do connect with them, click on their profile, connect, talk about it, and continue the conversation. We'll be putting up a document of this summary in terms of this conversation. So if you tuned in halfway or tuned in just to the start, then you'll be able to listen to this. Again, speakers, thank you very much for coming up. And I'll leave it to Ivan to close the space. Final thoughts, final words. Thank you.
Well, first and foremost, to everyone here, thank you. If you get a second, go to pixelboss.io and you have a bit of a look at what we're doing. If you're in Victoria, Melbourne, or coming through, you're welcome to our club. We're members only, but we welcome guests, and we're here to build together, as I said earlier. But above all, I do encourage people to, as I said, talk, ask questions. If you've got a good idea and we can help, fantastic. We'll certainly be reaching out to a few of you. There's a number of people in the room that we're currently working with and in discussions with. But onwards and upwards, and everybody have a lovely night or a phenomenal morning wherever you are in the world. But thank you for tuning in.
And love and GM, because it is good morning somewhere in the world. See you, everyone.
Have a great day, everyone. Bye.
Have a good night. Nice. Thanks.